Hello and welcome to Investors Hangout. This weekly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, this is World Investors Week, and digitalization is something that has completely changed the way we save, invest, and go about our personal finances. So, in today's episode, let's talk about it in detail with Dhirendra Kumar. Welcome, Dhirendra.
Thank you.
Now, as a mutual fund historian, you have seen firsthand how technology has evolved over the years, and so have markets. So, to start with, from your perspective, what do you think are the key advantages of technology in personal finance?
Now let me just share the changes.
Yeah.
And I don't think I have to explain what is the advantage because that is self-evident. Let me just tell you the speed of information.
Yes.
The first aspect. When I founded Value Research in 1990, I used to wait for the postman, and the mutual funds used to calculate their NAVs every 3 months, and they used to publish in some goddamn newspaper, which was very difficult to find out. The next progression was that the fax machines were invented, and there was an open-end fund where the NAV was calculated every day. So first, the NAV was calculated every 3 months. There were no open-ended fund. Then NAV was calculated every day, and then there are open-end fund, and then it was remitted. The information every evening was sent by a fax machine. So imagine I was getting a 5-month-old NAV, 3-month calculation, and publish it in the next 2 months. Now it is happening. Then it started happening every week. Now it happens every day on email. I don't have to wait for the postman. So imagine, the worth of your investment getting calculated. Earlier, we used to wait for the Economic Times next day morning, open the stock pages to figure out how the prices have moved. And, there was a, very definite character of those pages. Economic Times had a system that the stock pages, any stock hitting 52-week high or low will be bold. So if you saw that the newspaper stock pages are very dark, which means either it is high or low, so you are looking at things and trying to absorb or trying to figure out things or make sense of those numbers, whether they are close to the high or lows or where the market is. So imagine information exchange and access has been transformed and transformed beyond imagination. Then comes the speed at which you are able to remit money. Your ability to send it to somebody. You went to a bank to make a draft. Now you can do it on UPI. Now you are able to do it through UPI. Not only that, your authentication. Imagine, what used to happen earlier, that I chose to invest in a mutual fund. I decided that, this itself was a problematic thing, that first you had to fill 2 pages of information. My name, address, father's name, this, that, all the details, KYC information. In fact, in the initial early 90s, there was no KYC. Even PAN number was not mandatory. It's only that the Prevention of Money Laundering Act was implemented and all these things became mandatory, complicated. And validation became a very difficult thing. It actually created a lot of anxiety among people, and it is right, even now it causes friction. I have still lived through that phase where I was filling those 2 pages to make an investment. My children will actually stop investing if they have to fill those 2 pages, because they are post those form age. Imagine, I still remember very well that to make an investment, it was a complex thing. Getting an application form sometimes was a great privilege. When Morgan Stanley and Mastergain were launched, people queued up on Bahadur Shah Zafar Marg to get that form. Getting that form itself was a privilege. Today, imagine everything is happening digitally. Then to do your SIP, you have to give post-dated checks. Post-dated checks, and people will be very fearful that my check has bounced. Of course, mutual fund investment or any investment, it is not an obligation. When your EMI against a borrowing bounces, it might be, it will be poor credibility. It could be violating a contract. Not that I'm making an investment, that is not a violation, but that was the mechanism. There used to be all kind of forgery happening, that somebody took those 12 checks and replaced it with your form, his own form, or one-time investment replaced it. And that is when actually mutual funds became safe, when the law was enacted, that the mutual fund investments will be made or an allotted only in the name of the person from whom that check came. And the person who has invested the money, redemption proceeds will always go back to his bank account. The money cannot go in any other form to any other person. So that actually made mutual fund far more safer. Now, the third fallout is that all this actually added to the cost. You don't have to print those forms when you are investing digitally. You don't have to write those checks if you are moving the money speedily. And getting the confirmation and then SMS. This is another two-factor authentication that came about. So that secured your investment. So these are actually quite transformative things. And then combine it with, an online banking and Aadhaar and a Jan Dhan account, which, earlier having a bank account was a privilege. Your ability to automate this is a very magical thing. All the mutual fund SIP book that we hear of, 20,000 rupees a month, 20,000 crore rupees invested every month by individual investors in this country. This magical thing is possible only because people are able to do it with their cell phone, with their smartphone, and with their bank account, and with UPI at the back end. And getting started has become so convenient, onboarding a customer. So financial inclusion, customization, you come to Value Research Online, you set up your portfolio, and in 5 minutes time, we will be importing all your transaction history across mutual fund, for stocks, for NPS, and we will be able to give you your financial net worth in 5 minutes flat. That looks, magical. Not only that, once you take a look at it, we are going a step ahead. Our advisory is able to tell you that these are the bad investments that you have, these are poor investments that you have. And all this degrees, I would imagine that it would have required an organization of 50 people to do it manually. Today, every common, the smallest of investor with 5 lakh rupees investment, 2 lakh rupees investment will have access to that quality of framework being made available to him, which will help him take smart decisions and very sophisticated. Without so extreme personalization, extreme convenience, and this is customization of extreme kind, because you can have imagine every investor becomes unique, because if there's a 20-year-old kid, a person getting into a job, now assuming there are 5 of them, one person has to worry about his sister's wedding 2 years from now. One person has to worry about taking care of his family as well when he's 20-year-old. The third person has to worry about going on a holiday in Europe when he's 20 years. So, different person and having the same earnings capacity, ability to save, but their aspiration, their dreams, their expectation, that changes dramatically. And your ability to customize, make an investment plan based on that is possible. The person who needs that money, or somebody just badly needs to buy his bicycle next month, that is his emergency fund, or that will make his life easier. So you can actually customize to this extent. It will be impossible for a financial advisor to address these people at their ticket size in a viable fashion. Today, technology and digitization makes it possible. And today, because of the digital roadmap, digital flow of work, it is possible that if you have 10 lakh rupees worth of investment and you need 2 lakh rupees of emergency, you have a need for emergency, and you don't have that handy money, you will have to run to a friend to get it, who has that money, and it is up to him to really honor or give you that money or not. Today it is possible that in 15 minutes time you can go to a service provider or go to somebody who online, who will be able to fetch all your investments, understand what all your investments are, which is worth 10 lakh rupees. You can mortgage 1 lakh rupees worth of investment and take 50,000 rupees loan in 15 minutes, because the registrars are enabling a mechanism of putting a lien on your investment. So once you want to borrow 50,000 rupees, they will put a lien on 1 lakh rupees worth of investment in a specific folio, and you can choose the fund which you want to mortgage or get a lien on. You cannot sell it till you repay the loan. Now, this is a cheap loan. This is the cheapest loan possible because there's a high quality collateral. You can't, this lending has virtually no risk, because anytime you are unable to pay, somebody can sell your investments and recover his money, and it is at a 50% margin. If you want to borrow 50,000 rupees, you have to really get a lien or block your investments worth 1 lakh rupees. So this is something which could have, going to a bank, requesting a manager, it will take a couple of days, somebody will approve it, and now on your cell phone, somebody is fetching your investments, you are marking which investment you want to block, and you get your money in your bank in 15 minutes to half an hour. That I think is quite magical.
All this automation, it also has, data privacy is an issue now. Yeah. So what do you have to say about that? How can one?
Oh, that's a real threat. That is something which can actually completely derail the whole development. It can scare people, and it is beginning to happen. There's a big industrialist in Ludhiana who was robbed 7 crore rupee.
Yes.
So that really scares. It is not a matter of education. I think it is a matter of really understanding the reality. Every development, every progress comes with a risk. So is true for nuclear power. So is true for, digital finance. It is providing you all the convenience, all the magic, but then it comes with a risk. I think little bit of awareness, and I think a great deal of government initiatives. At Value Research, we get plenty of mails from people who have faced a digital fraud. Data privacy or stealing data from a central source should be taken far more seriously. Stealing my phone number, where you get all the spam calls, and spam calls in a context. Somebody knows what exactly I need.
Yes.
Based on what I purchased, so I can tentatively figure out. So it is understandable. Somebody is stealing some information of customers from a centralized source, and every now and then we also come across those news of the credit card companies or the computer companies or the online retailers losing their data. Losing their data by mistake is one thing that should be penalized, because if you don't penalize the companies who are responsible for preserving this data, this will cause a risk which is unprecedented, and more so in a country like India, where people will not have the context of what is the implication of this. And of course, we also need great deal of education, because you have to think that you have to really be taught and reminded time and again that every time you share the OTP on the phone, you are effectively writing a check. OTP is signing on the check, and you better be aware of it. If you're not aware of it, somebody will steal your money.
Right. And what are the other risks?
The other risk is that, people think that digitization will solve many of your problems. If somebody comes and makes a case that this is the model that I have developed, and if you do this, you will double your money every 4 months. Right. Or imagine the kind of belief people have in crypto. Right. Nobody is willing to question what it is. What is the underlying? But everybody thinks that it goes up, so it will go up. And because it is digital, so it must be magical. Nobody is willing to question it in a manner with suspicion. And that is my worry, that people think that some magic is happening, and digitization or algorithm is beyond suspicion. It can be trustworthy. Then fear of missing out. A lot of if you get to know that my colleague is doing it, my neighbor is doing it, my friend is doing it, you think you have to do it. No, everybody's context will be different. They might not be revealing the truth. They might just be stating about their profits and not their losses. They will not be so. And they just might be boastful, and you might get carried away. And your context and his context could be different. So you better be careful. Fear of missing out is not a great strategy. It is a sentiment. It is an emotion. And I think you better be careful. Otherwise, you will lose your shirt and somebody else will be smiling.
Right. And what steps do you think should investors take to avoid falling into such speculative, traps while investing?
One is very straightforward. Just be suspicious of the voice. When somebody pretends to be, your well-wisher, trying to help you, or an aggressive salesman, you just have to be careful. Stop your interaction as much as possible when it comes to sharing any private information. Because many a times I'm coming across frauds where somebody is pretending to be his father. Impersonation. And impersonation in the times of, artificial intelligence is becoming a reality. You have to be suspicious. You have to think that, okay, this is a crooked thing. Your assumption has to be that this is wrong. This is a lie. This is not true. And then it has to be proven otherwise. Somebody pretending to be a cop, somebody pretending to be calling from the thana, somebody calling from, somebody you just have to buy time and figure out, and things will get resolved simply because, the crooks will run away. So you have to really work on a ring fencing yourself. All the privileges of digital finance will be nullified if you're not careful. You have to think that everybody is out there to take your money, and you have to make sure that you are not revealing your name, your identity, your bank details, and your OTP to anybody. You should only, and also one extra care which everybody should be mindful of. Don't download anything when you get a link, because many a times our phones and our devices are getting compromised, hacked. When some malware comes and sits there because you got a mail, you installed something, and you don't know that somebody is remitting all your information without you knowing it, and that is something, and it's a hard thing to do, because most of us are way too naive to figure out that, okay, we have clicked on something which has compromised our devices.
Now, moving on to a viewer's question. 59-year-old Rajan says he has a reasonable level of risk appetite. He plans to invest 1.5 crore rupees accrued from property sale into equity. He will need this money only after 12 years or so, he says. Then he wants to know which type of mutual funds should he invest in, across how many months should he spread this investment, and what is your opinion on choosing some index funds that track Nifty Midcap 150 index?
This amount of money, 1.5 crore, depends that, if this 1.5 crore is 50% or 60% of your financial net worth, all that you have in terms of investments. If it is going to be 50-60% of this, then this money has to be spread over the next 3 years. Next 3 years, because catching a market high with this sizable an investment is a big risk in itself. It is an emotional risk. If you are faced with a 10% decline or 15% or 20% decline soon after you invest, so that is why you should spread it over the next 3 years. If this money is 10% of your total net worth, in all you have 10-12 crore, and if this 1.5 crore is 10% of that or 20% of that, then maybe 6 months, 1 year. How relevant it is in your overall scheme of things, that should be one. Investing for 12 years, you should be investing in equity. You should also be investing in mid cap and small cap to optimize your return. India is going to be a great story for mid and small cap. Mid cap index funds, 150 index fund is a promising opportunity. And I also feel that small cap and mid cap actively managed funds can also be good, because selectivity can add significant value to it. So maybe one should, investing for 12 years, sizable money, maybe 10, 20, 50% of the money can well be in micro cap, mid cap, small cap, all of it combined together, and a reasonable sizable part should also be in, large cap. Actively managed or, passive entirely depends on, your ability to choose a good fund, else passive funds are good. You have the definite advantage of low cost.
Right. Well, that's all we have for you in today's episode. Keep watching this space for more information. If you like the show, do subscribe to our YouTube channel. Take care. Bye for now.